So, when we talk about financial risk, what are we really trying to measure? You'd think it would be simple, right? But figuring out how much you could possibly lose is actually one of the trickiest and most important questions in all of finance. Okay, let's get into it, because the answer you get depends entirely on the tools you use to find it. All right, let's start at the very beginning. What even is risk? For most folks, it's just volatility, how much a price bounces around. But here's a question. Is all volatility bad? I mean, think about it. If your stock suddenly rockets up 20%, that's technically volatility, but are you complaining? Heck no. That's a great surprise.
And that right there is the big problem with standard risk measures. They treat the good surprises and the bad surprises as if they're exactly the same. But we're investors, right? We don't lie awake at night afraid of the upside. What we really care about, what we actually fear, is the downside, the potential for real, painful losses.
So, what we need is a different kind of tool. We need something that can ignore all the happy accidents and instead focus with a laser-like precision on the thing that actually matters. How bad could things realistically get? And that brings us to the question that every investor really wants answered. It isn't, how much is this thing going to bounce around? The real question is, over the next month or the next year, what is the absolute most I should be bracing myself to lose? Answering that question is the whole point of a metric called value at risk. Okay, so this is where value at risk, or VaR as it's called, comes in. It tries to give you a single concrete number. So if someone says your portfolio has a 5% monthly VaR of $1 million, what does that actually mean? Well, it means there's a 95% chance you're not going to lose more than $1 million next month. But, and this is the really important part, it also means there's a 5% chance that you will. It wraps up probability, a dollar amount, and a time frame into one tidy, powerful number. But here's the catch, and it's a big one. While the idea of VaR is pretty simple, actually calculating it, well, that's another story. See, there are a bunch of different ways to get to that number, and depending on the method you choose, you can get wildly different answers. It all boils down to one thing. What assumptions are you willing to bet on? All right, let's start with method number 1, the most intuitive one of the bunch, the historical approach. It's simple, it's direct, and you don't need a PhD in math to understand it.
You know, the thinking behind this one is super straightforward. It just assumes that whatever happened in the past is a pretty good guide for what might happen in the future. If you want to know your worst-case scenario for tomorrow, you just look at all your worst days from yesterday. Simple as that.
And doing it is just as easy. You just grab a ton of historical data, say the last 1,000 trading days, you line them all up, from the absolute best day to the absolute worst day. And if you want to know your 5% VaR, you just scroll down the list and find the 5th percentile. That number, that's your VaR. No complicated model, just the raw historical facts. Now, the huge advantage here is that it's honest. You're not forcing the data to fit some preconceived theory. But the downside, and it's a big one, is that you are completely 100% chained to the past. If something truly crazy and unprecedented happens, a real black swan event that's never been seen before, well, this method is going to miss it completely.
Okay, so that's the historical way. Now let's look at method number 2, which takes a more, let's call it a mathy approach. This is the parametric method, also known as the Gaussian method. So instead of just letting the past data speak for itself, this method makes a really big assumption. It assumes that all investment returns are normally distributed, that they fit neatly into a perfect symmetrical bell curve. In this perfect world, extreme events, both good and bad, are considered incredibly rare. And you know, the appeal of making that assumption is that it makes everything incredibly simple. If you believe returns follow a bell curve, then you only need 2 little numbers to calculate your VaR, the average return, or the mean, and its volatility. That's it. So you see the trade-off, right? It's super easy to calculate, but its core assumption, it's famously wrong. Real-world markets are not neat and tidy. They have what we call fat tails, which is just a fancy way of saying that crazy things, market crashes, massive rallies, happen way more often than this neat little bell curve would have you believe. And boy, can you see the danger of this assumption in the data. Because the Gaussian model is so optimistic about extreme events, it consistently underestimates the potential for huge losses. The VaR it spits out is almost always much smaller than what history, the real world, tells us is actually possible. It's like the model is wearing rose-colored glasses. Just how wrong can it be? Well, get this. Studies in the S&P 500 show that this Gaussian method can underestimate the 5% VaR by a jaw-dropping 41%. Relying on this model is basically like bringing an umbrella to a hurricane. It gives you this false sense of security right when you need real protection the most. Okay, so we've got one method that's stuck in the past and another that's living in a fantasy land of perfect bell curves. Is there a better way? A middle ground? You bet there is. Let's look at our third method, the Cornish-Fisher modification. You can think of this one as the best of both worlds approach. It's a really clever hybrid. It takes the elegant simplicity of the Gaussian model, but then it adjusts it to better reflect the messy, unpredictable reality of actual financial markets. It doesn't throw the model away, it just makes it smarter.
So here's how it works. It starts with that basic bell curve calculation, but then it adds a special correction factor. And that factor is based on two key measurements from the actual historical data. It basically asks two questions. First, skewness. Is the data lopsided? Are nasty downward surprises more common than happy upward ones? And second, kurtosis. How fat are those tails really? How likely are we to see a true, off-the-charts, panic-in-the-streets kind of day? By adding these real-world adjustments, it fixes the model's biggest weakness.
All right, so we've looked at 3 different ways to measure risk, and what's become clear is that it all comes down to a fundamental choice, a trade-off in how you want to deal with uncertainty. This table really lays it all out. The historical method has 0 model risk because there's no model, but it has high sample risk. It's totally dependent on the specific history you feed it. Then you've got the Gaussian method, which is the opposite. It's simple, but it has high model risk because its core assumption is shaky. And finally, Cornish-Fisher tries to thread the needle, adding some complexity to lower both types of risk. And this right here is the big takeaway. It is the ultimate trade-off in risk management. Are you more worried about sample risk, the danger that the past is no longer a good guide for the future? Or are you more worried about model risk, the danger that your elegant theory about how the world works is just plain wrong? And that really leaves us with one final question for you to think about. When you measure risk, you are making a fundamental bet. So which risk are you more afraid of? The risk that the future is just going to be a replay of the past? Or the risk that your beautiful, elegant statistical model is completely wrong? There's no single right answer, and understanding that choice, well, that's the first step to truly understanding risk.